Real estate investing is the top way to grow long-term generational wealth and even short-term wealth and high income for many real estate investors, whether you're new or inexperienced with low money to high amounts of money that you're ready to invest. However, there are ways that you can completely mess this up, and I want you to stay to the full end of this video so you can get a full comprehension as to how you can go about avoiding and what are some of the pitfalls in this video. Josh Tavares, investor and realtor with the eXp Realty Broker. It would be so great if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And without further ado, guys, let's get into this one. The number one way that anyone who's a real estate investor can completely mess it up and is a massive pitfall is buying overvalued real estate. One of the biggest mistakes I see real estate investors doing is buying high-end luxury properties that are super expensive, that they think in their mind is going to build long-term wealth for a massive portfolio, and that's going to be the way for them to build financial freedom from one property that is super expensive. Unfortunately, I've got an answer for you, and that's not how it's going to work in your favor. Now, when the market was hot, many investors were going about purchasing rental properties when the market was super hot and didn't care because the interest rates were low, and they knew that this property could build some long-term wealth for them. Unfortunately, because of what's taken place, there's been so many interest rate hikes, and we're seeing mortgages increase over 200% on certain loans. Some investors are definitely not in a good position right now. If you're buying overvalued real estate, one thing that I don't like about it is that it's going to come with a high price tag, of course, but it typically tends to have a higher expectation for rent in order to cash flow and pay all your expenses. So let's say you're going to buy a really expensive, maybe multi-million dollar property. There's going to be a higher rent expectation that you're going to expect. However, because many different people are feeling the hurt of what's going on in the economy as we speak, finding it a bit more difficult for jobs and whatnot, and becoming financially stressed at this point in time, we are noticing that these individuals are not going to be in the market to look for high expensive rentals, maybe less Airbnb and less traveling the world, things that for individuals who have a very good income, a little more stability, when the economy is doing really well, they're more likely to spend. We're looking at some rental properties here in Toronto that are going for a very high price tag that investors have purchased them for and expecting a very high rent of $5,000 to upwards of $20,000, $30,000 a month. We're talking about very high-end luxury condos and homes in the heart of areas that are very luxury driven, that it's going to be very difficult to rent these out to specific people because not everyone is going to be looking to rent out a home for $30,000 or even $50,000 per month. And not only that, there's going to be high carrying costs. There's going to be utilities, you've got your mortgage, you've got your property tax, you've got anything else associated with the property. If any maintenance happens, whether someone's on site or not, guess what? You're going to have to pay for that and have some sort of a crew come on site and fix the spill or any type of maintenance that takes place. To avoid this, I highly recommend to go about into markets that the price points are much lower, it's more sustainable, there's good economic growth, there's low vacancy rates, there's high rents taking place, and you're able to look at some leverage and you're able to look at your financial predicament and say, hey, we've got enough reserve funds that we can actually take on interest rates going up a certain amount. You don't want to be going all the way in with everything you have financially in the event that something takes place, like a massive maintenance that may take you 5-10 grand, let's say perhaps a roof. You want to have enough money to pay for that and then some in the event that something was to take place. That's why we highly recommend that anywhere you go about investing, you need to do your market analysis. You need to understand the rents, what properties are going for, how much you need properties to rent for. You need to understand all the expenses. You need, of course, understand the landlord-tenant board rules and anything as such to conduct an accurate analysis so you'll be able to have the right numbers. So when the right property comes to mind, you can purchase it, be pre-qualified, make the move, and begin to build cash flow and wealth. Number two, I already kind of hit upon this, is not having enough cash reserves. I can't tell you how many times I've heard stories of investors not having enough reserve funds, and especially when the market was hot, some investors were purchasing properties without having much reserve funds at all, and unfortunately they're feeling the pain as we speak. We always recommend that you need to have at least some sort of reserve funds, whether it's $30,000, $40,000, $50,000 in the event that something does take place. It doesn't have to be in cash, it could be lines of credit, credit cards, having some sort of access to cash. Even if you're gonna have to pay for interest, at the end of the day, that can be write off towards your property towards tax season. Remember, at any point, whether it's vacant or tenanted, anything can happen. We've had situations where we've had to redo the roof, we've had to do the garage door, we've had massive plumbing leaks taking place with tenants being at the property or even untenanted. So it's very, very important to have funds in place in the event that something does happen. We even had furnaces take place where it took a very pretty penny, over $4,000, to get a top-notch furnace into one of our rental properties to fix that issue. And it can happen at any point, and especially in this case for us, it happened in the winter time, so we were definitely feeling it from our tenants. And I get it, cash flow is king, and essentially you want to find properties that are going to cash flow. But remember, there's going to be times here and there where you're going to have to pay a little bit more, whether some sort of renovation or maintenance cost is going to take place, or even vacancy, right? That you have to have some sort of funds allocated and understand in the back of your mind and make that move and have funds available in the event that you need to do so. Number 3 is a really important one that a lot of real estate investors actually don't prepare for themselves for, and it's essentially the exit strategy. Whether you own the property yourself or you're partnered with people, it's very important to have some sort of an exit strategy in terms of the timeline and what you're going to do in the event that things do take place. Now, no one wants to have these type of conversations. Everyone wants to talk about what's good that's happening with the property, and I highly recommend that. At the end of the day, we do want to have positive conversations, and we don't want to manifest anything that's negative. However, we have to plan for the worst case scenario, whether it's going to be a financial situation taking place, whether it's a divorce taking place, whether there's some sort of funds that an investor may need to pay for. Let's say they need to go about paying for a family member's funeral. They don't have enough funds. They may need to sell a rental property to go about doing so. So plan for all these circumstances, and with other people in your life that have the opportunity to have influence on this decision. Like, we know investors who have gone to real estate investing. They were great with their partner, they had a wonderful relationship, and within 6 months to a year, they were actually divorced soon after and didn't look into an exit strategy, never spoke about how real estate investing can work together for them as a team, and really did the research they learned as they went along and found that their personalities did not click and ended up leading to the end of their relationship. We highly recommend that whatever you're going to do, whether you're holding it with your own spouse or you're partnering with other individuals, you have to have some sort of agreement in place that shows what's going to happen if something takes place, and what is the ownership, what is everyone's responsibilities, how are we going to keep everybody accountable, what's the time frame. Like, everything has to be in this order. Now, I know if you're probably thinking to yourself, I have my partner and I, we're in a really good time frame, my wife and I, or my husband and I. However, you need to plan in the worst case scenario if this type of maintenance call happens, if tenants do this to our property, if it takes this many months, even if it's exaggerated. I highly recommend have some sort of a plan, keep it in your Excel spreadsheet or keep it in your Google Drive and have it documented, keep it there, and have it in place so in the event that something does take place, you guys will have some sort of an exit strategy. So once things lean toward a unnecessary or unwanting territory, you'll be able to make the correct move to end that relationship or just remove and dispose the property itself. Number 4 is a big one that's happened since 2020 all the way till about the March of last year, and it's being over leveraged. Before March of 2022, we had interest rates hovering 1%, something we've never seen before, and many strategic investors who've invested for 20, 30 plus years would know that this can't be lasting forever. But for a lot of individuals who got into the game, whether it was purchasing their first property, their first rental property, they've seen rates skyrocket from low 200s, even high ones, all the way to about 6 to 7% as we speak. Now, we are talking about individuals who did take a variable loan interest rate where it was lower at the time than having fixed, but the individuals who stuck with fixed at about maybe 2.30 or 2.5 are the ones right now who are in a fantastic position versus the other ones who are looking at about a 6.5 to nearly 7% interest rate as we speak. This is leading for many real estate investors as well as individuals who purchase properties during this time for their own personal residence to see mortgage payments actually double, which for a lot of people, they didn't have that planned or have those reserve funds planned or have that type of conversation or some sort of thought in the back of their mind. They just thought interest rates would just keep going and going until perhaps they reach negative territory. And this is essentially all what happened when the pandemic took place. As we all know, that quantitative easing was taking place with the government pumping more money into the system because of what was taking place in the pandemic, making interest rates low and helping the banks keep everything low as well with the Bank of Canada. But as we know, with 2022 around springtime, that all changed and we've seen interest rates rise rapidly. Luckily enough, some banks are working alongside with the mortgage holders, whether it's increasing the amortization or allowing them to just pay interest and not pay principal. There's different ways you can go about working with your team. So I highly recommend you reach out to either your mortgage broker or reach out to your lending representative, the institution you're with, and work alongside what they can do to help support you during this time. In this point in time, it might even be smarter to look at different options. Now, refinancing might not be the most ideal, but for some people, they may have to go about selling their home and go back to renting or selling an investment property and be down one less property in their portfolio to kind of put them in a better predicament, which is really unfortunate. But this is something that it's going to happen to a lot of investors or a lot of individuals, providing an opportunity for investors in hand that do have cash, that are on the sidelines or were in the sidelines, ready to make a move. This is an absolute game changer in terms of generational wealth opportunity, that by taking advantage of it and having the funds to do so, or having the partners ready to do so, this can lead to a monumental opportunity in wealth generating capabilities. Number 5 is a really big one that we always stress, and it's not working or having a team. We've coached and mentored many real estate investors who have come to us because they did it themselves. They only were able to invest with 2 or so properties, and guess what? They were capped. They weren't able to go anywhere. They didn't have a proper team. They had to go from their home to manage tenant concerns and issues all the time. They didn't have the right lending taking place. They didn't have the right insurance. They were always working with individuals who didn't have their best interest and didn't really have a team. They just kind of went with whatever was convenient instead of working with the best individuals for their needs. If you're a real estate investor, like we said on countless occasions, you want to work with individuals who focus in real estate investing. You want to work with a realtor who's got rental properties. You want to work with a mortgage broker who has experienced rental properties and has their own. You want to work with a real estate lawyer who is also an investor, who's able to know about what can take place on the legal side. You even want an accountant who can speak the language of the real estate investor and understand. You don't want to work with individuals who just have their own primary residence, don't have any real experience, and are just working with you because they're looking to, of course, pay their bills. I get that. We all need to pay our bills. However, as a real estate investor, it's a complete different ball game, and we need to work with like-minded individuals who will be able to help lead us to the right territory. And that's why for us, it's super important that we've always worked with property management and be willing to give 8 to 12% of our rents, because then we know we can save time, money, resource, and energy on having those things taken for us. Now, in some cases, some real estate investors may argue and say, you know what, I'd rather do it myself because I know I can cut costs. I know that I can fix this repair. I know the cost of this type of expense. And that's fantastic. Maybe you can save some expenses, but time is more valuable than money in a lot of occasions. Now, you may have to pay a little bit more here and there for certain maintenance requests. Typically, the property management teams have a very good relationship with individuals and give them a lot of work, so they're able to keep their prices low. However, now if you go about doing a lot of these maintenance yourself, of course you're going to save money. But the time you'd have between getting into your truck, driving all the way over there, finding the issue out, having to go to Home Depot to get materials and supplies, and taking time away from your family and your other activities you like doing, is completely, in our eyes, not worth it. And many of our investors have actually come to us about not having a team and wondering what's the best process to go about getting a team. And we're always big on recommending referrals and working with individuals, like I said, who are real estate investors. And remember, sometimes these individuals who have rental property, whether a mortgage broker, accountant, insurance, realtor, it doesn't matter, they tend to have like-minded individuals who they're working with, who they had a wonderful experience. They'll be able to refer you to someone who is fantastic in the field, who's responsive, who understands the perspective. And at times, it could cost a little bit more, but to be honest, you're probably going to get a better job done and even more thorough than someone who doesn't understand real estate investing. Quick tip we say to all our investors is that we highly recommend you have a good relationship with these individuals. These individuals can make or break your business. So you want to make sure that you keep them close, you take care of them, you stay in touch with them, and you're able to stay like-minded and stay top of mind with these individuals. So when something comes up and you need someone for maintenance help, you need them for mortgage, you need them for realtor services, anything as such, you want to be top of mind and you want to take care of them like they're going to take care of you as a client. I hope that video is super helpful, insightful, and helps you avoid all these pitfalls and gives you all the information needed for you guys to become successful. I'm Josh Tavares, investor and realtor with DXP Realty Brokerage. It's so amazing. If you can help us out, hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. Thanks so much for watching, guys. See you next time.